Welcome, and thanks for tuning in to the first episode of Congressman Warren Davidson's new podcast. My name is Christine Revolt. I'm the Congressman's Communications Director. In these discussions, the Congressman will take deep dives to more fully explore issues before Congress and in the news.
Yeah, I'm looking forward to having a little dialogue with folks. Hopefully, this will be something that probably won't appeal to everybody, but it'll get, a little more depth, and we'll try to have dialogue where Christine will ask questions that some of you might have about a given topic, and hopefully that'll flush out answers and explain more depth behind some of the policies. So, been kind of an ongoing frustration she and I have had with social media. It's hard to provide context and depth on a tweet, partially by design, right? So, short amount of characters convey the most essential point is the spirit of it. But this is kind of the other end of that spectrum where we can go deeper. Hopefully, not so deep anyone goes to sleep, but if nothing else, maybe it'll be helpful for that.
Well, hopefully it's not a cure for insomnia. At the very least, we know that the story we're going to talk about today is pretty exciting and has caught a lot of attention. And that is, of course, how Reddit really took on Wall Street at the end of January last month. But it was a story long time in the making. Since the start of the COVID-19 pandemic, we've seen a pretty dramatic increase in retail investors using apps, particularly Robinhood, to invest and participate in financial markets. And combined with information sharing on social media, particularly the WallStreetBets subreddit, you have a much higher level of engagement at a much lower level of barriers to entry or intimidation. The forums are informal, full of emojis, and people sharing and laughing at their own losses and gains. So it's kind of been on the scene for a while, but it really captured everybody's attention in January when a bunch of, frankly, activist investors were able to come together and increase the share price of GameStop dramatically. Originally, Congressman, you thought it was a pump and dump scheme. But what's really come into the light is that once retail investors were in a position to squeeze hedge funds, that all of a sudden Robinhood shut off trading, and it left a lot of people confused and angry. And I think, let's start there.
Yeah, I mean, obviously, Robinhood's not brand new, but for a number of folks, they never really heard of it. I'll tell you, young people are using it like crazy. The growth of the platform has been, pretty interesting to watch. But for a long time, people have seen Wall Street disconnected from day to day life, and particularly, tend to be something that older people pay attention to as they start getting more responsible and saving for retirement and all those things with 401ks and IRAs or other types of saving instruments. So the whole concept has kind of captivated people. In particular, the idea that these Reddit thread posters could squeeze the big hedge funds on Wall Street. I talked to a number of people who literally bought one share because it was their view of how to stick it to the man, even if the share did well or bad, poorly. They were excited to be able to participate in this effort. So hopefully it holds enough attention to get some not just a hearing, but some reforms.
Yeah, so I guess to take it back a little bit, the Financial Services Committee, which you sit on, is going to be hearing from a number of players in the GameStop short squeeze, as we've been referring to it here. But when you first heard about what was going on towards the end of 2020, you originally thought this was a pump and dump, right?
Yeah, I think a lot of people felt like, the Reddit thread was really a way to, it's still, a way to pump up a stock, right? So they're definitely talking up the shares in this thread. And look, there are people that talk up shares of any given company. People that are optimistic about a share can talk about it. But if there's a coordinated activity, then it can become actual criminal activity where you hold a position, you engage in activity that's designed to move the market, and you place bets concurrently with that. And a lot of people on Wall Street felt like that's what was happening to them. Things that they would get in trouble with if they did. Somehow, the individual investors that were out talking openly on Reddit threads in a way that they would get in trouble doing, they felt like that's what was happening to them, and it was hurting the Wall Street investors or the institutional money.
I think you couldn't have this discussion about what happened with GameStop and Wall Street if you don't have two important things here. If you don't have a forum on Reddit within the shape of Wall Street Bets, and if you don't have Robinhood, which really changed the way the average investor could engage with financial markets.
Yeah, absolutely. And one of the big innovations that Robinhood has been able to do is offer, small dollar accounts to people that they don't even charge money to execute trades. I mean, I remember years ago it was kind of an innovation when E Trade launched, and they would do trades for $9.95, and that made it accessible for younger people making smaller trades. But it was a deterrent to make too many trades because it cost $10 per time you made a transaction. But that was much simpler, self-directed. You didn't have to go to a broker or things like that. And things have come a long way since then. That put pressure on bigger institutions over time, all the way to where Robinhood's now kind of, not just them, but others have created an architecture that lets them charge the retail customer no fees for executing trades.
So we have a whole bunch of people on Reddit. They're pumping up stock and talking about different trades and bets they're making. And for the most part, it's an unregulated but transparent and open platform. And then one guy figures out that the hedge funds are over leveraged on GameStop.
Yeah, so and calls attention to it to say, look, here's a chance to um, see this turn out differently. And so here are all the good cases for why their position is bad. They're making some assumptions that GameStop is going to tank, that there is no future, and they make all of the most pessimistic cases, and really kind of got very heavy bet that GameStop wasn't going to survive the current environment.
And
And
so that's them going short, just for people at home who aren't familiar with going short, going long, and how the different terms that are going to play out work here.
yeah, so that's exactly it. So when you believe that the shares aren't going to perform well, that's the short position. You believe that that's there. It's a specific type of trade that's made that says, "Hey, I believe I'll make money if I believe the shares are going to go down in value." So the hedge funds, in this case, the biggest one that's going to get a lot of attention in the hearing is Melvin Capital. But lots of folks to the point over 100% of the shares were in a short position. So when you see that, this is one of the most shorted stocks ever, right? So on Reddit, they call attention to that. Is like, is this really the share that should have that much attention on its imminent demise? And so in a free speech forum, Reddit does this for all kinds of things, but in this specific subthread called Wall Street Bets, they started talking about the optimistic case for GameStop. And then the question is, did that free speech dialogue turn into a coordinated, you know, violation that were others to do it in different formats? Um, would it be considered, collusion or market shaping uh, to advance a particular side of a trade?
You have hedge funds who do that all the time. They go on MSNBC or Bloomberg and they talk about why they think a stock is garbage or a stock is going to do well. And just that by going on a wide platform, they can affect the price of shares.
Yeah, clearly shares move on news. I mean, if you look at most sites that track shares, they tend to move on news. And some people will, you hear a good story and, oh my gosh, I have to sell this, or, oh wow, that's pretty encouraging. That could happen. And rarely do you get context and dialogue. And, in investing, a lot of times people specialize in this, and there's analysts that follow the big shares. I don't know how many people are employed to analyze Apple, but across the market, Apple gets lots of attention, right? Because they have massive market cap. Any fund or big portfolio is likely to own shares of the big companies like Apple, Microsoft, Amazon, Alphabet / Google. But if you look at some of the smaller companies, they don't get as much attention. So, they can move pretty radically based off of what little attention they get.
And there was a good case on Wall Street Bets for why GameStop could improve. They had a new CEO who had just invested a lot, who had success in taking a brick and mortar business into an online business. But as the Reddit investors started investing and buying up GameStop, they really did squeeze the hedge funds, and that created a whole different set of issues.
Yeah, and when often when short sellers, you start talking about a stock, they'll start getting a lot of attention because they make big bets that the company's not going to perform, which creates news, and then they go on and talk a lot about all the pessimism around why they're in this short position, and rarely is it accused or are they accused of manipulating it. It's the long position. Oftentimes, the SEC is treated with extra scrutiny, and they've given kind of a asymmetrical treatment to short sellers. And when short sellers start talking about the pessimistic case for a company, but this company has no future, well, obviously it makes it harder for that company to get access to capital. They start losing employees, start losing board members. And in this case, GameStop actually attracted some key talent, as you allude to, which is newsworthy. They say, oh, well, somebody might see something there. And because there was a different venue to get this coverage, GameStop was able to make the positive case. Because any business, prior to coming to Congress, I was starting, growing, and acquiring manufacturing companies. And the optimistic case, when you start a company or acquire one, you obviously believe in the future of it. But the challenge is when you're operating is to get lenders, for example. Debt is less expensive than equity, which is the stocks are traded as an equity. The debt is you're borrowing money, whether it's from the bank or a bond market. I'm paying really low interest right now. So you want to be able to go to the market and borrow, and you can do that at a much lower cost. But when you've got this big hedge fund saying this company has no future, it makes it hard. It closes off that. And oftentimes the management team, if they can get access to the capital, they can change the business model. And that was essentially what the Reddit thread, Wall Street Bets was able to convince a number of people. And then it started morphing and gaining momentum because they said, not only is this possibly true, what's definitely true is if this share keeps going up, the hedge funds that have been shorting it are going to get squeezed. They're going to lose their position. Because when you short a stock, you can't just say
And it's
directly
important to point out that if you go short, you can lose an infinite amount of money.
You can
So
lose.
there's not a cap on your losses there.
Right. So you can get hurt far worse in options, or you can make far more in options. There's a big multiplier effect there. So this is going to get a lot of attention. Exactly who should be authorized to trade options, and should the government basically have some criteria that says it's okay for you to trade options, but not you. This person can, but this person can't. And so,
but that market hasn't been closed to hedge funds. They always have the ability to operate. But now we have the retail investor coming in and putting them on notice.
Yeah, absolutely. And they want to have access to be able to compete. Obviously, I mean, the hedge funds are the most sophisticated investors, but the idea that the retail investor could participate in some of these sophisticated trades gets it. And part of the timing that the Reddit thread realized, A, we can participate because we are authorized these options accounts, and B, if the positive case for GameStop turns out to be there, if the shares keep going up, these people that have been making the negative case that the company's going to die, those options have expiration dates, right? So you can't just be for the options market, you have to be right about the direction, but the harder part is you have to be right about the timing. So when that timing expires, you can either have you know an upside or a downside. And so when we do this, there's going to be another concept that we come into, which is trading on margin. So not only can you trade the options accounts, you can also trade on margin, and that really means essentially you're going to borrow money to make the trade, right? So
which increases everybody's risk here.
everyone's at more risk. So you think about that as like if the whole concept of saving is that you put a little bit of money away and over time it compounds, and that kind of has gone away a lot of times in our market. One of the real challenges of zero interest rates is when you put money into a savings account, it really doesn't earn anything, right? So people can't truly save and have that traditional time value of money compounding interest. For the average retail investor, there isn't a market for that. So that's pushed them to go into the Wall Street side and make investments into marketable securities. And here, people that don't have a lot of savings, say, for as little as $5,000, $10,000 in an account, they could start to trade on margin. So then you can turn your $5,000 investment into, as an example, a 50% position. You put 50% of the piece in with your 5,000 in cash, but you borrow another 5,000 and you essentially buy $10,000 worth of a position or a share. So that's how a margin account very simplistically would work. And so when people trade on margin, they're committed to have that 50% position, and as the example I'm illustrating here. And what some people didn't realize is that when you trade on margin, you're subject to margin calls. So when the position, in this case an option, short or long, moves, then that share price movement could result in a margin call. So there's cases where people didn't really realize that those margin calls were going to force them to sell their position. So they bought the shares, in this case of GameStop, and made the positive case. I believe the shares should go up. I'm going to buy these shares. But because they were trading on margin and they didn't have money in their account, and they weren't sophisticated investors, so they didn't put stop losses on the orders, back end ways to structure the orders. Some of those accounts traded all the way down to zero. They just force sold, and the margin called down to zero.
I think we sort of glossed over like the big event, though, was that as the hedge funds, Melvin Capital in particular, were getting squeezed and the stock was, rocketing up and it caught everybody's attention, not just Reddit's, Robinhood made an announcement. You are no longer able to trade on these highly volatile stocks.
Yeah. So, and that all happened concurrently with these margin calls, right? So a lot of times, the shares started going down because, people were able to sell their shares, but on Robinhood in particular, they weren't allowed to buy more shares. And what? How
And
could
other
that possibly
companies
happen?
too increase the margin to 100%. So you're actually not able to borrow margin trade because you can't borrow. You have to have 100% upfront.
Right. So if you don't have cash in your account, where yesterday you could trade on margin, but today, even though you still have a margin account on a certain set of shares, GameStop in particular, some companies said you can't trade on margin. You can only trade the cash that's in your account. And so why and how could that happen? Is really important. It gets pretty complicated, and that's going to get a lot of attention, in our hearing.
So the day Robinhood closes, the day that Robinhood closes down purchasing positions on GameStop, the entire internet explodes with anger and anxiety because for some reason they can't buy, but the hedge funds are able to. And at the time of this short squeeze, when the hedge funds are trying to buy up to cover their own positions, everybody else can't. So we have a sort of David and Goliath, like the Redditors and the activist investors want this stock badly because it's going to put hedge funds in a bad position. And after a terrible year and 2008, you have all these people who've been looking at Wall Street and saying, what we want in. How come you guys always win no matter what you do? We want to win and we're going to win, but now you're taking out our opportunity.
Yeah, absolutely, and that's where like I say, along the way, people wanted to participate in this, and it wasn't just that they wanted to win. They also some people really wanted Wall Street to lose. They were taking a lot of, I guess, Schadenfreude kind of joy in the fact that some of these hedge funds were going to get squeezed, and for once, Wall Street wasn't going to be the winner here. And that's where I talked to some of the folks who just bought one share, and they're like, "Well, I hope it goes up in value, but even if it doesn't, I want to say I was part of this, sticking it to Wall Street." So you had a lot of momentum going to do that, and so here's what's going on in the back end. So when firms like Wall Street or like Robinhood want to make investments, they take money and they set up an account for you. But then, and you say, I want to buy shares, in this case of GameStop. They place that order, and that order gets placed with market makers that actually do the execution of the trade, right? And that
And these are like
doesn't
third party middlemen that most people never come in contact with.
right. So one that'll get some attention, for example, is Citadel Securities. So they execute this trade, and part of the way that that Robinhood can not charge their customers money for completing that trade is a concept called payment for order flow. So they actually get money as Robinhood because when they sell all these orders, they need the best price execution on this. These companies like Citadel Securities and market makers around the country are in competition to do that at the lowest cost. So they bid to do the order, the best price that they get, then they execute the trade. Now they pay Robinhood money, but they complete the trade on behalf of a whole bunch of Robinhood's customers, and in their case, any number of other customers from Fidelity's, Schwab, TD Ameritrade, you name it, all these companies that you think make investments and other funds that move money. So all that block gets executed, and and
But these
when
hedge
it
funds also
does,
use that information.
they benefit from knowing that information, and that's why they find value in it. They pay for the order flow. That's payment for order flow, or PFOF, and the settlement for the consumer when you buy those shares and it shows up in your Robinhood account that I bought 100 shares of GameStop, for example. Um, you don't possess those shares. What you really possess is a claim on those shares. On the back end, Robinhood tells the securities company to make the trade. The securities company makes the trade, but they don't get possession of the shares for 2 days. This is a concept known as a clearinghouse. The DTCC settles these over 2 days. So it takes really 2 days before there's real custody behind the shares. And as you can imagine, there's trading, back and forth all the time. So the claims on those shares sometimes are, overstated, and that is one of the areas they're going to get concerned with. A, why should it take 2 days to settle this with the kind of tech that we have today? And B, how do you make sure that there aren't more claims on shares than there are shares? Kind of like musical shares. You've all heard of musical chairs where you're, as a child, elementary school game, moving around the chairs, the music stops, and there's one less chair than there are people, and you keep, eliminating people until the game's over, right? In the case of musical shares, what could happen is if you have more claims on those shares than you really have shares, in a bad event, there could be a scenario where there are more claims than there are shares. So with the kind of tech we have today, we have an opportunity in this hearing to talk about legislation that would, um, you know, change that so that there aren't multiple claims on the same share.
So the settlement part of this from the Depository Trust Corporation, DTCC, I have to check that acronym actually. They called it Robinhood. And in order for Robinhood to have its transactions go through DTCC, which is required by the Securities and Exchange Commission legally, you have to use a clearinghouse. DTCC then tells Robinhood, we need a lot more money up front in order to complete the settlement and the transaction on these. And the settlement is going to take 2 whole days.
Right. So there's a time period like that. So essentially, every day they find out how much capital do they have to deposit in their account. This is a constant. It's always 2 days, but you're really told like today, how much cash do you have to have on hand to cover this? And in their case, Robinhood was told like $700 million, and they had the money for that, or claimed to have had the money for that. But then they also get this extra charge because of the volatility, and that happens heavily when the position is one sided. So a lot of times, companies will have, a whole market is established because there's some level of equilibrium between buyers and sellers, right? If there's only buyers and no sellers, the price keeps getting bid up until somebody's willing to sell, right? And if there's only sellers, then the market's in total free fall until at some price people are willing to buy. Um,
So a whole bunch of retail investors got a notice from their online broker saying, there's a lot of volatility here. And for your own good, we're going to stop you from purchasing these things. And then there's a little bit of a side note about SEC regulations that just about everybody consuming the news that day looked over because it was wonky and difficult to understand, and no one knew what it was referring to. But it actually turns out to be very key to understanding what happened that day.
Yeah. So when those things aren't in equilibrium, then the DTCC has to reserve additional because there's a lot of risk. It could skew a lot. So ultimately, what GameStop says is they were confronting a need for nearly $3 billion of cash on hand, and they didn't have the money. So they're like, "Wow, that could shut our whole business down. We would literally not be able to trade with anybody." So we have to find a way to operate. So this is all happening like the market opens at 9:30, and this is all happening, at 6:30 in the morning. So pre-market hours, a couple top executives at Robinhood and other firms are in total spaz. Like, how do we have to react? We have to get the business to operate. And so they made decisions on the fly. And we're going to spend a lot of time in the hearing talking about, those decisions. Were they the right decisions? Why did they happen? Right now, one of the shocking things is no one from DTCC is supposed to testify. So exactly why did DTCC say, not only do you need the 700 million, you need this other $2+ billion to cover risk. So Robinhood reacted to that, and they had to put limits to be able to satisfy concerns that they wouldn't be able to cover all the trades for the day. And they couldn't block people from selling because think of the risk to Robinhood. They could say, well, you've got money on deposit with Robinhood and you couldn't get rid of it. You own these shares and Robinhood controls them for you, but you can't sell them. Now they've dropped in value. Robinhood couldn't expose themselves to that risk, so they had to say, we have to sell them. They would have had real problems. The question is, how could they say, well, you can't buy them? Well, they couldn't cover the cost of buying the shares and covering that T+2 float that they're really covering. So they said, well, we can't execute that. In the worst case, their claim was you could buy the shares somewhere else, but Robinhood as a company couldn't execute that for a period of time. And so that's why it's really their credit problems And so for that reason, Robinhood went to investors and said, we need more cash. But that took
A
over the
lot
weekend
more cash.
like $3 billion, which says that a lot of people believe in Robinhood, that this is going to be a future market for them. They've added customers. They certainly got lots of press. And they raised $3 billion from investors, private investors, I will say, not publicly traded. So private capital that your average investor wouldn't have been able to make any investment in that. A lot of people would said, I'd love to make an investment in Robinhood, but frankly, accredited investors can make that, which is a different kind of issue where, essentially the government's already kind of paternalistically said, yeah, only some people can make these kinds of investments. And for most of America, that's not you. So those people that are connected like that could make $3 billion worth of investment in Robinhood over the weekend.
Which enabled Robinhood to slowly taper off some of the restrictions they'd placed on this highly volatile stock. And while we're talking about GameStop, I'll just add that it included a couple of other really nostalgic brands like Koss headphones or Nokia phones that other firms had shorted, and people thought, I'm going to invest in those much more of an activism than a chance to make money. So after the outrage caused by Robinhood saying, hey, we're going to limit trading on these stocks, you can only sell them, CEO of Robinhood, Vlad Tenev, goes on MSNBC and says, we don't have a liquidity problem. So it's not about this thing that was actually the problem, because he was probably trying to keep investors in Robinhood calm. Meanwhile, it creates a whole lot of confusion at the retail level, which is if Robinhood is liquid and has the ability to cover its positions, why are we not allowed to buy? And I think that what's going to happen here is that the PR and the crisis communications, speaking a little bit from my area of expertise, was a complete failure. They should have been much more transparent with people and said, we do have a liquidity problem. We can't cover the volatility on the stock. Retail investors have taken Wall Street by storm. And frankly, in my opinion, and correct me, retail investors on Reddit broke the system. They completely pushed the edges of what was possible under current regulations.
I would say that, and they may have crossed some lines, frankly, in terms of how some of that conduct resulted in trades for people. I don't know, because it's so decentralized, how equipped the SEC is to deal with that reality. But that's probably going to get some attention too. Just because you do it in a more public place on a Reddit subthread, it doesn't mean that you should be treated differently than, say, somebody was doing the exact same thing on a Bloomberg terminal that Wall Street investors use, and vice versa. If you say, oh, well, we're going to go after these retail investors because they did things that shaped the market, and in order to specifically profit from those actions, we're gonna give them scrutiny that we wouldn't give to professional investors that are using professional grade equipment, commonly Bloomberg terminals that dominate Wall Street. So this information flow is essentially how Michael Bloomberg became a billionaire. Aside from the things that are more commonly known, the terminals that trade this investor data are common all over Wall Street. And a lot of that kind of information now is flowing outside those channels. So you see hedge funds even going, we better start paying attention to forums like Reddit for information, because we know now that can really move the market. So they've had to update their risk models to see what can influence share prices.
Yeah, and so the squeeze on GameStop seems to have really tapered off. Some people have decided that as much fun as it is to squeeze the hedge funds, that they have a tidy profit they can make here, and they sold. The price has gone back down to earth. And unfortunately, that does leave some people holding stock that they bought at a high value that is at least not what they were promised on Reddit, going to the moon, but it is a little bit better than worthless unless something changes in GameStop's business model and quarterly earnings.
I mean, they clearly have the potential to change their business model, but it was also clearly completely disconnected with what they could generate in a fundamental way. And look, that's not uncommon in Wall Street. I mean, demand for the shares has, publicly traded companies trading at 25 times earnings on average. Now, GameStop for a period of time was like astronomically off that, right? So
Completely divorced from reality.
yeah, there's just no possible way. The growth rate would have had to have been phenomenal, or their profit margins would have had to be there in a traditional way that every MBA program, Master of Business Administration program, would teach you how to value a company all over America or the planet. That is known as fundamental analysis. And you look at technical analysis, this would be, yeah, but there's still supply and demand for the shares. And in some way, that's kind of what's happened for Amazon for years. People say, well, they're not making that much profit, but meanwhile, they're they're one of the most valuable companies ever in history, right? So it wasn't because they were making a lot of profit; it was the growth rate. But even still, it started to be a phenomenon to say, well, I mean, if you're going to put this kind of a fund together, then you have to own Amazon. So it created its own sort of demand. And so the market on Wall Street is incredibly divorced from Main Street, and that's been a phenomenon all of 2020 because heavily the pandemic and not just the health aspects of it, the kind of government reaction to the pandemic has really disrupted Main Street businesses. But meanwhile, the S&P 500 is at record highs. That's not truly rational either.
And that's
And
after a year where you had a crash in March that was phenomenal. It triggered circuit breakers on the New York Stock Exchange, and oil went negative.
yeah, literally people were paying money to haul the oil off. It's like if you could show up with tanker trucks or ships to offload it at refineries, you would be paid to put it onto your ship or storage container. And now it's recovered and going back up, and you'll see prices at the pump going back up. But this is where the markets have become so disconnected from the reality, the fundamentals. So GameStop kind of broke that in the sense of, how can you kind of artificially create this high demand for something that the underlying value isn't there? And that's a real concern because whenever that happens, whether it's in the real macro sense, like, the S&P 500, Dow Jones, right now, the overall aggregate economy, having Wall Street broadly valued so highly, but Main Street not really being there fundamentally. Well, if the demand drops off, you can see the valuations go way down, and those people that get in late are the ones that get hurt. And so that's where a lot of people will look to the government to say, "Hey, if you don't stop this artificial hype." Or limit the ability for this artificial hype to be there, people are going to get hurt. And the sophisticated investors, the theory goes, the sophisticated investors aren't going to be the ones that get hurt. It's the least savvy investors that catch the trend late, and they go, "Oh, okay," and they put
Which goes
money in
back to
late
your
and get
accredited
stopped.
investor point that you wrote about in Real Clear Markets as this was all churning about. You know, there's so many things that are closed off to an average investor, and now Robinhood seems to be closing off, its own branded app, which is supposed to be for the little guy, and that's now closed for you too. But look at the barriers to entry everywhere else.
Yeah, and when we look, we've talked to people that are writing code for companies, and they literally are writing the code that's going to create a tech company, for example. But they can't own shares. They can't put, let's say they've got $10,000 or $25,000, and they want to help fund this early stage company. They're not able to buy those because they don't meet the accredited investor criteria. Just like when Robinhood had their call for $3 billion to try to raise to deal with their challenges, which included liquidity. Um, the average investor couldn't get access to that. And the average investor, that would be inefficient for the market. It's easier to bring on one investor than hundreds or thousands or millions of investors. It's obviously easier to deal with a smaller number of people, but those deals are out there in a very small scale way in terms of crowdfunding. And the Securities and Exchange Commission made it possible to do a little bit more of that. And they've made it possible for early stage companies to raise capital in from non-accredited investors in some limited ways. And that gets into things like, Reg A, Reg A plus, Reg D. So some of the things that really get tedious, um, you already have to start learning a lot to either raise the capital or participate in those markets. So Robinhood and other kinds of platforms are trying to kind of demystify some of that stuff. And the question is the current level of safeguard adequate? So when you think about it, everyone that uses the internet or an app or anything is used to getting some terms of service and they just click OK. I mean, the reality is people don't read those things. They're 400 or 500 pages long and some 6-point font if you print them out. And so some people will drill through them. In theory, the Federal Trade Commission is supposed to hold companies accountable for doing what they said they would do in those terms of service. But the question is it really count as informed consent? And so I think that's one of the questions here is when Robinhood or others approve an investor to say, hey, you can trade options or you can trade on margin. Do you really understand the product well enough? Now, I don't know that you need a master's degree or some additional credential like a chartered financial analyst or something like that to pass your, investor exams, or you certainly don't necessarily need to already be a high net worth individual to do some of
Which
these
is the
things.
current standard. You have the SEC's accredited investor standard, I think, requires some $2 million on hand or over six-figure income for the past couple years, or net worth that doesn't include your home. It's a high barrier to entry, and it really sometimes reads like a wealth test.
Yeah, I mean, and look, I've said it, maybe somewhat cynically and in a partisan way, which isn't always helpful, but deal flow for Democrat donors, and I mean that in the sense that Democrats generally are the ones that are paternalistic in this sense that say, well, we have to protect people. And I was doing a forum with some fintech, financial technology businesses that are working on cryptocurrencies in particular. And one of the programmers was upset about this, and he's in this early stage company and can't participate. And he's like, why do you rich Republicans block regular people from participating? And the intuitive logic to him was that Republicans would be the ones that are protecting the wealthy in this case, and the Democrats would, in theory, be in support of democratic access to capital. And you saw a rare moment here where that was the initial reaction Congresswoman Ocasio-Cortez had to this Robinhood scenario. She's like, hey, regular people on Reddit threads should be able to participate in these markets. And then you also had the conservative Ted Cruz say, hey, we agree. Now, the conversation went elsewhere after that and off topic. But the reality is you had this moment where you had people on the far left and the far right of America's political spectrum or current political spectrum, at least office holders, saying the same sort of things: is the average person should be able to access this. And I don't know whether that will hold. I think it would be great if it does, but the status quo is there's a bipartisan sense of Congress that you do have to protect the average person because they're not as sophisticated of an investor. I think we can do that in a way that's knowledge based and not, high net worth based. And I hope we can get to that as part of this hearing and debate.
One of the last things I wanted to touch on, just because of your background with crypto, is going back to that settlement problem. The T+2, Robinhood came out a couple of days after they sort of sorted out their public relations issue and said, we need to do better than 2 days. And for background purposes, I think it was 2015 or 16 that the SEC changed it from 2+3 to T+2. Pardon me. What's it going to take to get to instant settlement, and could blockchain be a way to get there?
Yeah, so there are a couple ways to solve the problem. So there are multiple ways to get to T0, which would say, hey, today at the end of the day, you have to settle for everything, and the market's only open for certain hours, right? So the idea that if the market closes, late afternoon, that you can't by midnight have everything batched. Now the upside of doing a T0 over real time is you can net settlements out. You don't literally need to do a transaction for every buy and sell. So if you looked at it at an individual firm, since we've been talking Robinhood so much, let's just say at Robinhood, their payment for the day really only has to cover the nets, right? So let's say you had $1 billion worth of things that you bought, and $500 million of things that you sold. You would have to pay, $500 million you acquired. So you'd have to pay in, $500 million for the day, and that would settle the account. And you could do it all in one big transaction. That would be, trading day 0. You could do that all in one. Right now, that time allows for all the netted positions to come out over 2 days, but you could do that same day. But you could also do it real time, where every transaction is literally a transfer of money. And as you start going towards more real time, then one of the super efficient ways to do that would be blockchain, because you could tokenize the shares. That every token would represent an individual share, and every transaction would be accounted for. You would guarantee that there would only be one claim on that share. That's a really different architecture, and hopefully something we'll go into deep to explain blockchain to people. But could you do that without true blockchain? I think you could. I personally think blockchain is going to innovate, all of the digital architecture over time. It's a more secure way to do it. But for efficiency, even energy efficiency, there is a way to stack those and do them, one larger process at the end of the
Kind
day.
of crunch it out.
Yep. But I think that's where the technology is probably headed.
So, what are your predictions for this hearing this week, which is going to be very exciting? We've got Vlad Tenev. We have the Redditor who made the predictions on GameStop going up, and a couple of hedge funds.
Yeah, I mean, I think it has the potential to be great. I'm excited because most of the country is actually interested in financial services for a little bit. Most people will say it's important, but it's not exciting, right? I mean, we're never going to fire up a political rally talking financial services. This is one of the things that kind of resonates with people. The last time we had this much attention on a financial services hearing was when Facebook was going to launch Libra. And so there was a lot of attention on that. And unfortunately, a lot of the conversation in the hearing turned into, individual members of Congress expressing their feelings about Facebook broadly and not about the topic at hand, which was their concept of Libra. But it did direct enough attention there that it really moved the needle in the debate on how we were going to deal with the crypto market. And then we had a second hearing that got far less press that was afterwards, that was pretty focused on crypto and less about Facebook. And my hope is that we'll focus on the content here, but my confidence is many of the members will focus on the kind of your top level messaging of David versus Goliath, Wall Street, and kind of meta messages, instead of really getting into the depth that's going to fundamentally change the status quo. Because what happens is, just like Libra last time, because it was so focused on Facebook and not focused on the root issues, Congress really preserved the status quo, and the status quo is broken. We need laws. And right now, what the GameStop short squeeze, the Redditors on Wall Street Bets kind of broke the market in a sense. Um, well, that's not going to be that's the status quo is not going to be fixed by kind of these standard tropes for five
Right,
minutes
because
at
the
a
next
time.
time Reddit finds an over-leveraged short position on Wall Street, it could absolutely trigger the same thing.
The same
Whatever
thing.
that stock
So
is going to be, I think cannabis was the last really hot one last week. Um, if they're going to organize a short squeeze again, assuming it's legal, transparent, and not a pump and dump, they're going to run into the same problem, which is the depository requirements.
yeah, and they'll be frankly, Robinhood will be strengthened, and frankly, the barriers to entry just went up. They went up by at least $3 billion. So if somebody wanted to launch a competitor to Robinhood, their window to do it is going away
Gone.
because now it's going to take not only is it going to take what it initially took to launch Robinhood, it's going to be at least 3 billion more because Robinhood couldn't do it, and the next time it'll be more. So what happens when Congress fails to take action is it entrenches the interests that benefit from the status quo. And part of the whole focus of the hearing should be how do we change the status quo? Because the status quo is broken, or we wouldn't need the hearing. And often is the case, the hearing serves as political theater, but at the end of the day, the status quo is preserved, and Congress doesn't lead, doesn't take action, and maybe quietly and privately hopes that some regulator, like at the Securities and Exchange Commission or FINRA or somewhere else overseeing the market, steps up and does the right thing. But Congress far too often serves as nothing more than political theater. I hope that's not the case on Thursday.
So how would you fix this? If you had a majority and the rest, what would be your solution to fixing what happened so that activist investors and retail investors don't come up against this barrier that was created by regulations?
Well, so that really becomes incumbent on the majority, because the majority in Congress, look, it is collaborative sometimes, which is great, um, but it's collaborative in such a different way. Maybe another good topic. But the majority decides: A, are we going to have the hearing? B, who gets to participate in the hearing as the witness list? And C, which bills, if any, to notice for the hearing? And then afterwards, you would think, well, since we had the hearing, now let's, as members of Congress, come together and collaborate and see, like, what did you take from the hearing, and do that. That part doesn't really happen formally in Congress ever. So the key is for the leadership to make sure it does happen in this case, and we come together on some bills that could help change the status quo. And when we do those bills, I think the other piece that would be really important is to make it so that in the committee there is real dialogue about an amendment process, so that even the people that agree on the consensus could at least debate amendments to whatever their idea is, so the broader committee can weigh in on them. And often those individual bills don't get much merit because they get rolled up into one macro reform, and then the handful of people that structured that
Right, which
bill.
we learn by the name Dodd-Frank, and nobody knows what's in it, except we know
Right.
that Wall Street hates it.
The litmus test on it is the bigger banks have gotten bigger and the smaller banks have been harder to survive. So while the big banks, I think they doth protest too much. They might not necessarily like it, but they've been made stronger by it, and fortified against competition. And that often, as I was alluding to, that's often the net effect. So it really takes leadership, and the majority in Congress holds all the chips. So the minority can plead about it. They can go on press and complain about it. They can assert positive ideas that generally don't get coverage, particularly on financial services issues. But you really need collaboration and a willingness from the majority to say, let's talk about how we could change the status quo. So I hope that we can, because there really are some thoughtful solutions on the horizon for this. And the technology makes a lot more possible than what's happening today.
So, what would the positive idea from the minority on committee be to fix this?
I think a couple of big things. One is we need to get to T
We
zero.
do.
So when you make a trade, individual firms should settle that day. I mean, and the technology makes that very viable. The other big thing is whether, regardless of the architecture, I don't know that Congress should dictate exactly which architecture firms use to do it. But you should say you can't have multiple claims on the same share. You could be creative about how to do that, but GameStop had 138% of the shares shorted. Now, no one can deliver 138%, and there's some technical explanations for how it currently happens, but I think at the end of the day, you have to make sure that you can't have multiple claims on the same share. So that's part of why right now in the T+2 is to make sure that over those 2 days, the competing claims settle out and you're clear who does it. And this is important not just for the shares; it's also who gets to vote the shares, right? So when you have voting for the direction of the company, retail investors hopefully can be empowered to truly be shareholders. Because when you own a share of a company, I mean, you have a say in the state of that company. So you get to vote that share. And platforms like Robinhood could make the direction of corporate America really different by having a voice there, because who normally has fun? Well, big hedge funds, they get a seat because they own lots of shares. So they vote their shares. And often these other firms, there's really only two major players. One's got like 80% of the market, called proxy advisory firms vote the shares. So if you look at kind of what's driving some of this kind of change in direction for corporate America, a lot of it's because, well, big pension funds own the shares, state pension funds own the shares, Wall Street hedge funds own the shares. Main Street America, while they own the shares, they're not necessarily voting them. So when you make sure there's only one claim on the share, not only does it deal with the market conditions, if you had a platform like Robinhood that equipped people to actually vote on the core issues of the company, you could really see a direction in the change of corporate America.
Well, I think that's exciting. And even if we don't hear it at the hearing, this is a really good discussion for people to understand more about what's underneath the hood of the headlines. There's just like GameStop's wild. Well, really, the SEC regulations are what's wild and what's kind of driving some of the larger headlines here. And it's harder to understand, but kind of worth taking the time to explore.
Yeah, and look, in 1994, there was a change that when you take custody of shares, it's really you have a claim on the shares, not real possession of the shares. And that was right as the public was becoming conscious of the internet era. Back then, AOL was kind of the leading edge of internet for the average retail consumer. And Wall Street kind of updated their things. I don't know, around 4 years ago, they updated from T3 to T2. But that wasn't very ambitious. I mean, frankly, there are a lot of intermediaries that make money off of this lag time. And I don't begrudge them for making money. Frankly, the ability for them to make money in that time frame is part of how the retail investor can trade with no fee, no commission, and execute trades. But I do feel like the technology makes it possible for all those same things to still happen and settle in at T0. And I hope we can get to that as a result of this.
Okay, well, I think we're going to wrap up this discussion for right now, and we're going to look forward to the hearing. Thank you so much for the time, Congressman.
Yeah, thank you. And thank everyone that took time to hear us for right at an hour.